When people picture new money entering the economy, they usually picture a printing press. That does happen in a narrow sense. Central banks issue physical currency. But it is not the main way most of the money we use every day comes into existence. Most modern money is not paper. It is numbers in bank accounts. And one of the most important mechanisms behind those numbers is ordinary commercial bank lending. That sounds strange. So in this video, we are going to follow one simple loan from beginning to end. We will separate cash, bank deposits, and central bank reserves, show what actually changes on a bank's balance sheet, explain why banks cannot create unlimited money, and connect the whole thing to your own financial resilience. Start with the definition. The Federal Reserve describes the money supply as including cash, coins, and balances in bank accounts. Its standard measures distinguish the monetary base, M1 and M2. For households and businesses, the crucial point is simple. A checking account balance functions as money because you can use it to make payments. You do not need to withdraw paper dollars before buying groceries, paying a contractor, or sending rent. There is also another form of money most people rarely see: reserve balances that banks hold at the central bank. Those reserves are used for settlement between banks and are part of the monetary base, but they are not the same thing as the deposit balance you see in your personal checking account. So when we ask where money comes from, we have to ask, which kind of money? Imagine a bank approves a $300,000 mortgage. A common mental model says the bank first finds $300,000 that somebody else deposited, then hands those exact dollars to the borrower. That is not a good description of modern bank lending. When a commercial bank makes a loan, it records two things at the same time. On the bank's asset side, it records the borrower's promise to repay the loan. On the liability side, it credits a deposit account with spendable bank money. The Bank of England summarizes this mechanism clearly. When banks extend loans, they create deposits. The new deposit did not have to be transferred from a saver's account first. That does not mean the borrower became $300,000 richer. The borrower gained a deposit and an equal debt obligation. Money was created. Net wealth was not magically created. Now suppose the borrower uses that deposit to buy a house, and the seller banks somewhere else. The deposit moves to the seller's bank. Behind the scenes, the two banks have to settle with each other. This is where central bank reserves matter. The lending bank may need to transfer reserves to the receiving bank. This is one reason a bank cannot simply create unlimited loans with no consequences. Lending changes the bank's balance sheet, affects its funding and liquidity needs, and can create settlement obligations to other banks. A bank that expands recklessly can run into capital, liquidity, funding, credit loss, profitability, and regulatory constraints. It also needs willing, creditworthy borrowers. Monetary policy matters because interest rates affect both the demand for loans and the economics of supplying them. There is another side of the process that is easy to miss. When principal on a bank loan is repaid, the corresponding deposit money used for that repayment is extinguished from the banking system. In plain English, bank lending can create deposit money, and repayment of principal can destroy deposit money. Again, this is not the same as creating or destroying real wealth. A factory, a house, a skill, a business, or a productive machine is not the same thing as a monetary balance. Money is a system for accounting, exchange, settlement, and storing purchasing power. Wealth is broader. So where does the central bank fit? The central bank issues physical currency and central bank reserves. It also sets the monetary policy environment in which commercial banks operate. Interest rates influence borrowing, saving, asset prices, and the incentives banks face when extending credit. This is why two popular statements are both incomplete. Statement 1. The government prints all the money. Too simple. Much of the spendable money used by households and businesses exists as commercial bank deposits. Statement 2. Banks can create infinite money out of thin air. Also wrong. Banks create deposit money through balance sheet expansion, but they operate inside a system of capital requirements, liquidity needs, settlement obligations, regulation, credit risk, market funding, borrower demand, and central bank policy. The useful model is not a conspiracy, and it is not magic. It is accounting inside a regulated monetary system. Understanding money creation changes how you think about financial resilience. Credit is not just a private agreement between one borrower and one saver. Bank credit is connected to the creation of deposits, and changes in credit conditions can ripple through spending, housing, business investment, and asset markets. When rates rise, debt service becomes more expensive for many borrowers, and new lending can slow. When credit is easy, households and businesses may take on more leverage. Neither condition guarantees prosperity or disaster, but both change the financial environment you operate in. Your defense is not predicting every central bank decision. It is building a household balance sheet that can survive different credit conditions. Manageable fixed obligations, adequate liquidity, thoughtful borrowing, diversified income where practical, and enough margin that a rate reset or income interruption does not immediately become a crisis. If you remember only 3 things, remember these. First, money is more than notes and coins. Bank deposits are a major part of the money people actually use. Second, when a commercial bank makes a loan, it can create a matching deposit. It is not simply moving a fixed pile of existing deposits from one customer to another. Third, money creation is constrained. Banks face capital, liquidity, settlement, regulatory, credit, funding, profitability, and borrower demand limits, while central bank policy shapes the environment around them. Those 3 ideas explain far more than the printing press picture ever could. Money becomes less mysterious when you separate the different forms and follow the balance sheets. In the next Stormshield Mindset video, we will move from the monetary system back to the household level and examine 5 financial decisions that can matter more than income alone. If you want to build a stronger financial foundation, the Stormshield Financial Resilience Checklist will organize the same principles into a practical review. Liquidity, debt, fixed costs, protection, and long-term capacity. Understand money, build resilience, protect your future.